All right, and we are live. How's it going, friends and family? Dude, I just woke up. It's like 6:30 a.m. I usually have a very high-pitched voice, but I don't know. Whenever I wake up first thing in the morning, the voice is a little deeper. Sounds more masculine. I like it. But anyways, welcome to another earnings week. And if you can't tell already by the production value, dude, this is going to be laid back. Okay, it's practically a podcast. I would encourage you to listen to it while you're, driving to work, or put one earbud in at work, or do something else while you listen to it, okay? Between you and me, it's one of my more favorite videos to make because it's essentially what I do at the start of every week. I like to know which businesses and companies are going to be reporting their earnings. That way, they can be on my radar and I can pull the trigger if there's a very emotional reaction from the markets. Because usually, not always, but from what I have seen, if a stock says something that offends the feelings of a hedge fund or a Wall Street investor, they can be punished like 20-30% on a single trading day. And then by next week, they bounce back and they're the exact same price that they were. So I like to take advantage of those situations. And if you're not in know, earnings is essentially when a publicly traded company tells you how their past 90 days have been going. And they also give you any updates and guidance for the future. Like, hey, this is what we're looking at. These are the roadblocks, speed bumps that we're going to be navigating past. And if you're invested into any company, just look at your portfolio, right? If you're invested into one of those, it would behoove you to stay up to date, to figure out what the heck is going on with them. Because the investing thesis as to why you bought into them in 2019, it might not be the same in 2026, okay? But before we go anywhere, let's do a quick little recap of last week. First thing that I want to talk about is Walmart. On Thursday, they reported, dude, the earnings was just absolutely beautiful. It was so good. However, they sold off because of conservative guidance going forward. Now, one thing that you have to keep in mind with Walmart, this is not a sexy tech company with a sexy CEO that's dancing on the stage like Elon Musk, right? They usually give a guidance that under promises, but then they always over deliver, right? That's the kind of mindset and strategy that they have. They hate to give a bullish guidance. I don't know what it is. It's just the way that they operate. And it's the perfect example of a company that has a high PE ratio. I think Walmart, leading up to the earnings, they had like a 52, 53. To put it into perspective, Amazon, their biggest competitor, their PE ratio, depending on when you look it up, it's like a 24, 25, 26. So Walmart had double the trading valuation, the trading multiple, which is kind of bonkers. And my whole thing is, if you're priced, let's say your PE ratio is above a 30, that's when I would argue you're priced for perfection. And in Walmart's case, it was a 50-52. And when you're priced for perfection and you don't give diamond farts and your nipples are not lactating gold, dude, you're going to get punished beyond belief if there's any setback. Because usually when a company like Wendy's, for instance, right? I think it's a cigar butt, terrible business operation. Their PE ratio going into their earnings about 2 weeks ago, it was like a 6. And then lo and behold, their earnings was absolutely horrific and the markets didn't punish them. It just stayed flat because their trading multiple was a freaking 6, which is the PE ratio. And then like a day or two later, this billionaire, I forgot his name, Nelson or something like that. He's like, hey, I think Wendy's might be undervalued. And then their stock popped by like 30%. But needless to say, the trading multiple is really important because it dictates the severity of how the markets are going to react depending on what you say. And despite the sell-off, I think some of the good news, or I guess the good thing that I heard, is they announced a $30 billion share buyback program. And I think they said that their e-commerce arm of the business is just absolutely destroying the competition as of right now. And yeah, so if you're investing into Walmart, I don't blame you. I think it's really high quality. But do I see myself jumping in at its current price and PE ratio? Absolutely not. There's far better deals in the market. I don't like buying into a company when they're fat You know, with the FOMO of like, oh, but they're so, oh my gosh, everyone's buying into it. I feel like it's my last chance. When you operate with that mindset, that's when you lose money. Time and time again, like if you FOMO into a company and you buy into them at their all-time high valuations, like Palantir, right? There's some folks that bought into them at $175, and now they're roughly what, 120, 130? The thing is, Palantir is a really good company, but I can never buy into them above the price of 150. For me personally, I'm not giving Palantir a fair look until they're $75 a share or below, when they're trading multiples around a 60. That's how I operate, right? That's like value investing, but also with the principles of GARP, growth at a reasonable price. When a company trades for a 500 or a 600 PE ratio, for me, I already know that it's irrational and I don't want to go near that stock because it's not trading based off of fundamentals and financials. At that point, it's trading based off of hype, narrative, speculation, and I don't really like going into that territory, right? Because I feel like if I can sum it up my investing philosophy into one phrase, it's common sense. Like, would you want to buy something that you know deep down inside it's worth $50, but because everyone else is like jumping up and down and they're like their pants are down to their ankles and they're having a ding dong measuring contest and now it's all of a sudden it's $300 out of the blue? I mean, would you want to buy into it at 300 knowing full well it's 50? Probably not, right? It's kind of like like I'm looking at used cars, right? And let's say you're looking at a freaking Toyota Sienna, which is a minivan, and you know the Kelley Blue Book, like the valuation of that used car that has 150,000 miles on the odometer is $5,000, and this bozo off of Facebook Marketplace is trying to sell it for 15 grand. I mean, would you want to pay 15 grand? No, that's exactly my logic. I would not pay 15 grand. But anyways, I don't want to go on too much of a rant because that's for later on, right? Because right now we're trying to do the high-level recap. And then what else happened last week? Let me take a look at it real quick. Yes, we also had Verisk right there on Wednesday. They reported, dude, it was stellar. It was just like Walmart, but they also went on a sell-off because they gave a soft guidance, meaning it didn't exceed the expectations of people. Like, say you met someone on a dating app, and then on their profile says they're freaking 5'7", they've got a master's degree, but you meet them, and they're barely 5'1", and they have a GED. It's kind of like that, right? You gave a soft guidance. It's like, what the heck? Your expectations were not met. And this is a stock that I shared with the Patreon, and I'm monitoring them very closely because when you look at my software landscape tier system, they're in tier 2. Proprietary data, super high quality. And the reason being why I'm more excited than ever is because they just raised their dividend payout by 11% and they announced $2.5 billion of share buybacks. So, pretty good. Pretty good opportunity, but they're not at the price that I want to jump in yet. And then what else happened last week? I mean, a lot happened, right? We also had Texas Roadhouse reporting after the markets closed on Thursday. Dude, I know this is going to be a very controversial take, but as a stock, I think they're pound for pound the best in the restaurant landscape as of right now. I think an argument could be made about a year ago for Brinker International, the parent company for Chili's. But as of right now, I still think it's Texas Roadhouse. However, having said that, this is going to sound absolutely weird. Their earnings, it was a little hairy. Hairy in a bad way. Like chest hair coming out of your t-shirt, falling into your food, and then you blaming the server saying, why is there hair in my food? And it's like, dude, it came out of your own chest, okay? You big old nasty. The reason why it was hairy is because they missed the top and bottom line expectations. What do I mean by that? The top line on the P&L, which is the income statement, is the revenue, right? The gross sales. How much money did you make holistically in 90 days? And then the bottom line is what's left over on the P&L and the income statement. What's the profits? So the expectations for the top and the bottom, they didn't meet. They missed. And that's mostly because the price of beef has gone up. Now, I live in Japan. I'm not in the know, but apparently there's a shortage of American cattle. So consequently, the price to do business is more expensive because they're in the business of selling steaks. So for Texas Roadhouse, I thought they would be punished harshly, but it seemed like it's already priced in. And that's because their trading multiple was moderate. It was like a 23-24 PE ratio heading into the earnings, and they stayed relatively flat at about $180 a share. This is a company that I do own in my portfolio. I bought into them 2019. Dude, in 2019, I was so weird. I like to buy into companies where I enjoyed their products and services rather than doing a really deep dive into their numbers and data, which is what I do now. So back in the day, I bought into stuff like Texas Roadhouse, Cracker Barrel, what's something else that I really liked? Crocs, a whole bunch of random companies that, it's a miracle, call it luck. They all worked out. Like, I sold out of them at the right times, but it's like, man, when I think about my journey as an investor when I was a beginner, I mean, I still consider myself an idiot, but when I was straight up new to the markets, man, I was so lucky. I got lucky. Yeah. But anyways, what else? We also had Figma report their earnings last week, and they just absolutely crushed across the board. They're basically a competitor in the landscape of Adobe. Adobe tried to acquire them, and the approving agency said no. It would be a monopoly for antitrust reasons, it cannot happen. And so Adobe ended up paying Figma $1 billion for their troubles. The troubles of not becoming a part of Adobe's portfolio. But anyways, after Figma reported, their stock went up by 25%. And I categorize Figma into tier 4 as a horizontal tool, just like Adobe. So I'm thinking, listen, I'm not invested into Adobe, and I'm not wishing ill or negativity for you, Adobe investors, but I think there's still hope for Adobe. Because if Figma can pump by 25% for solid earnings, they're right there on Wednesday, why can't Adobe do the same, right? And I think Adobe is still high quality. I think their future business model, yes, it's absolutely disrupted. If you go one by one and take a look at all of their product offerings, their tools that they do, like Photoshop, After Effects, and all that, yes, AI is coming to eat their lunch, but Adobe's also integrating AI into their features. So I think the bigger question is, will they be able to retain their customers? I think the battle of trying to acquire new customers, dude, I'm not trying to be a Debbie Downer. I think that's a uphill battle. But I think for them, it's kind of like the SiriusXM business model, right? The parent company of Pandora. They're not necessarily trying to acquire new customers. They're just trying to hang on for dear life to the people that are already bought in and just increasing the prices that they charge the existing customer base. And for me, dude, I'm not really a fan of that, but I could be wrong, right? Maybe Adobe will roll out another feature or a product that's mind-blowing to the point where designers, video editors, photo editors, and everyone starts flocking back to Adobe. But I don't know. We'll see what happens. But having said all of that, after taking a look at Figma and Adobe, giving them both a fair perspective, I would rather go with Figma. With Adobe, I just feel like the sentiment surrounding the company is so negative. Even if they are crushing in their numbers, they're going in a downward trend, right? And with Figma, I feel like the momentum just swings back up to the upside. So for me, I would rather go with Figma, even though I think Adobe has a bigger economic moat. Yeah. Now, with that out of the way, let's go ahead and take a look at what's going to be happening this upcoming week. And if you want to go ahead and take a look at your screen right now, you might be sitting on the toilet, you might be cooking dinner. These are all the various companies weighted by market cap that are reporting. Now, obviously, we have some big names in tech, including NVIDIA. I think every butthole on Wall Street is going to be clenched until they say what's happening, right? Because I think so much of the AI bubble is predicated upon the sales of their chips. Here's the thing, with NVIDIA, everything's priced in already. The expectation is that they're going to exceed and smash the top and bottom line. That's priced in, okay? All the markets, the only thing the markets are going to care about is the guidance that they give. Like, say they're anticipating, I don't know, like $200 billion in sales for their chips. The markets, they want to know if that's going to be $240 billion. Does that make sense? And that's the thing with like buying into a high growth company with a very high trading multiple. It's priced for perfection. You have to understand what you're getting yourself into. And that's why as a value investor, it makes me a little uncomfortable, but it also makes sense. Like if you're executing numbers where the top line's growing at 80% year over year, and the bottom line, the efficiency of your business is increasing by 50, 60, 80% year over year, I can justify a PE ratio of a 40. You know, maybe we can jump it up to like a 45. With NVIDIA, I think, here, let me look them up. So on a GAAP basis, the trailing 12 months of their earnings, their PE ratio as of right now is a 47. So it's kind of fat, but it's not ridiculous, especially when you take into account their forward trading multiple. When you bake in next year's EPS, it's 27. So having said that, for NVIDIA, it's definitely one that's on my radar. I personally do not think it's a buy and hold because I think the landscape of semiconductor chips is fierce competition and it's very cyclical. Right, so for me, I would buy in and I would want to sell out of them as soon as I get like a 20-30% pop. Personally, that's what I would do. I'm not recommending anyone else to copy me. So I'm personally hoping, maybe for selfish reasons, I'm really sorry, please forgive me. I have small feet. I'm an idiot. I don't really have friends except you guys. I hope their guidance is bad. That way, it triggers a domino effect sell-off for like a day or two. For everyone that I'm trying to buy into, including Broadcom, AMD, NVIDIA themselves. That way I can buy into them and then sell out of them. But knowing NVIDIA and understanding that China's markets, their doors have opened, and NVIDIA is selling their chips to them, I think their earnings are going to be good. Now, that's not biblical truth, right? Anything can happen, but I think things will be okay. But also in the tech landscape, right below them, we also have Salesforce and Snowflake reporting. If you watched my tier landscape video, you would know that both of these names are in the tier 2 category. And then we also have Baidu, which is a Mag 7 stock in China. Personally, look, the face, it's Nigerian, right? But my ethnicity, I'm Asian, okay? I personally would never buy into Chinese stocks because of the involvement of their government. And with shaky accounting that has happened in the past 5 years, there was this one really, gosh, it's going to bother me if I can't remember it right now. It was the main copycat competitor to Starbucks. I think it was called Luckin Coffee. And I think their mascot is like a deer or a reindeer, something with like antlers, right? And they were cooking the books. And so they got kicked off the U.S. stock markets, right? So, like, knowing about horror stories like that, I just try not to go near the Chinese companies, right? Absolutely can be high quality, but as a stock investment, I mean, think about it, right? There's like 20, 30, 40,000 publicly traded stocks. Why do I have to buy Chinese stocks? I don't have to, right? Especially if I know that I can just buy the American equivalent of the Mag 7. Why do I have to buy Alibaba? Why do I have to buy Tencent? Like, sure, their business might be good, but as a stock, right? I personally wouldn't go near it. And I know a lot of people got burned badly because of Charlie Munger, 2020, 2021. He went balls deep into Chinese stocks, and I know a crap ton of people followed suit into him. And I actually uploaded a video in 2019 talking about this is just not it, guys. Like, at the end of the day, on a fundamental basis, what is the government system in China? They don't operate off of a strictly capitalist society, right? Cooking the books over there. I'm not trying to insinuate anything, and I'll just reserve my tongue, okay? So I know there's a lot of people that are holding on to Alibaba, and they're down 20, 40, 50% from following Charlie Munger. Speaking of which, that channel where I uploaded those videos, I actually deleted all my content and I threw in the towel But I will be sharing those videos very soon on this channel to talk about how I've been the same guy for the past 7 to 8 years. Well, my humor changed quite a bit. I used to be a lot more funnier when I was in my late 20s, but now that I'm in my mid 30s, I feel like I'm more watered down. I don't know what it is, okay? It's like as soon as you grow hair on your chin, you just become weird, and I guess that's what's happening. Yeah, I couldn't really grow facial hair until my 30s, which is hilarious, because when I was in the military at age 18, dude, my friends, they had to shave twice a day, right? Otherwise, the sergeants would be on their butts. But for me, I didn't even have to shave, which, looking back, that's kind of funny, right? But anyways, also this week, we already know that consumer spending is business as usual. Why? How? Because Walmart told us things are okay. I mean, the higher income demographic is doing proportionally more of the spending, especially with the Las Vegas landscape. Dude, if you want to know why I feel kind of scared about the near future, just look at Las Vegas. Like, even 2 to 3 years ago, I feel like the demographic of the consumer spending in Las Vegas, it was more balanced. There were people whose median household income was $40,000. Likewise, there were people that were like millionaires, right? You fast forward to today, it's almost predominantly people above like $200,000 in their median household income. Like people like you and I, people that are just average, people that are below average, they're not spending as much right now. The rich folks are the ones that are going balls deep right now, and they're propping up the economy with discretionary spending, gambling, casinos. The poor folks, we're just making by right now. And so if you're invested into Vici, which is a company that's reporting on Wednesday, if you're invested into these companies that are balls deep in Las Vegas, dude, I would just hesitate, pause, reflect, and look at what's happening in the landscape over there. But yeah. Having said that, dude, what was my train of thought? Oh yeah, we have companies like TJ Maxx, Marshalls. They sell, I guess, high quality stuff that's like a year or 2 or 10 years old. They'll usually buy stuff from Nike, Adidas, Reebok, Under Armour for like a 60% discount. That way they can get rid of it from their warehouses, reduce their overhead costs, make room for the next season's goods. And then TJ Maxx will store it in their warehouse and slowly bring it out to their floors and sell it for like a 5, 6, 7% margin. I personally think TJ Maxx is a good place to go to get underwear. I know it sounds hilarious, but people don't talk about underwear enough. Like, there's a huge difference between getting a Walmart Hanes, which I used to do, and getting like a really high quality, like a Calvin Klein or some other high-end brand from TJ Maxx for 50% of the cost. Dude, it's a night and day difference for the gonads. I'm just telling you, right? And what else we got? We also have Mercado Libre. Dude, I'm super bullish on that company. If you what is this, a philosophy channel? If you take into account my 2026 stock picks video that I uploaded, I don't know, like 4 or 5 weeks ago, I think that portfolio is crushing right now, by the way. But that's neither here or there. Mercado Libre is 5% of the portfolio's allocation. It's basically the Amazon of Latin America, except they focus heavily on fintech. They're not in the business of data centers like Amazon. So it's kind of different, but kind of the same. And based on my deep dive video, I learned that in 2026, the conservative estimate is that 1 out of every $3 spent in Latin America will be to Mercado Libre. If that doesn't get your nipples perky, I don't know what will, right? What else do we have in the consumer space? We also have Domino's, which, did you know Berkshire Hathaway, they own 3.3 million shares of Domino's Pizza? Call me stupid, call me weird, but it's one of those restaurant stocks that I bought into in 2019. I just never sold out of them. It's a dividend compounder with cheese for sure. Pretty happy with that. And it's kind of weird to see Berkshire Hathaway being one of the biggest shareholders of Domino's, but it is what it is, right? And what else do we have? What else do we have? We also have Home Depot, and we also have, oh, right there, Thursday. We also have everyone's favorite language learning app, Duolingo. Now, obviously, they're also diversified with chess, mathematics, and music. Here's the thing. To me, it's a tier 4 SaaS. I'm not very bullish on them, but I'm also not going to turn a blind eye to their financials and fundamentals. Super high quality, really good. It's just I do not believe they have any economic moat. But having said that, look, right now they're trading for what, like $110, $112 a share? I still think there's more room to fall, right? And I mean, last time they reported their earnings, I thought it was pretty good, but they were telling Wall Street that they were going to double down on trying to maximize the experience for the existing customers and try to gain more customers rather than trying to profit off of each customer, like increasing the prices. Wall Street punished them really harshly. I agree. It was overblown. So having said that, I don't even know what's going to happen to them. Like they have to come out and straight up say something that's bonkers to make their stock price go back up. So low key, fully transparent, this is where I draw the line. I think what's happening to them is a little ridiculous. If they do drop to $80 a share, $80, I'm jumping in. Maybe. I'll think about it. Like, if they say something that's outrageous, diabolical, a scandal, of course I'm not going to buy it, right? I'm a reasonable guy. But if it's business as usual, revenue's growing at 40%, they're crushing, and the stock market still punishes them, dude, for me, I feel like I'll jump in. I'll join you bag holders at that point, okay? That's the kind of stuff that I usually say on Patreon. I give like the exact price points and then also the exit prices as well. But that's neither here nor there. And then also on, I think it's Tuesday, right? Is it? My gosh, my vision is not so good. It's like 6:55 or whatever, 7 a.m. in the morning. Axon. Okay, so I think there's also some high-risk stocks, such as Hims and Hers Health on Monday, and they just got their face slapped. Like the people that watch YouTube here and there, do you remember a few years ago they were pumping on the homepage the slapping championships, like out of Russia or whatever? Dude, I could never do that. You'll have people that are like 6'5", 300 pounds, and they take turns slapping each other as hard as possible. I'm like, dude, that's the fastest way to get TBI, right? Traumatic brain injuries, concussions. I don't know why you would ever sign up for that. Like, you can't defend yourself, and you have to allow them a clean slap to your face. You know, it's like, I don't know, it just blows my mind. But anyways, Hims and Hers Health, for the longest time, their tailwind was making a generic GLP-1, which is like a weight loss drug, because there was a supply chain shortage. Shout out to Novo Nordisk. Dude, they fumbled the bag so badly. They were the first, hold on, let me think about it. First movers advantage with the pharmaceutical breakthrough of creating a drug that helps people, fat slobs like me and you, lose 18% of their body weight in a matter of weeks, right? I listened to a podcast by The Economist, and the insiders leaked that they did not anticipate that it was going to be a soaring hit. Are you stupid? Seriously, are you stupid? So as a result, they didn't ramp up their production or prepare their supply chain to make an adequate amount of supply. So what ended up happening was there was a shortage. And so it allowed their competition to jump in and steal their market share. And that's why Novo Nordisk, terribly ran company, right? It's like, what an embarrassment. Eli Lilly is the market leader. I think 50% of the GLP-1 drug landscape now belongs to them. Whereas previously, it was 100% Novo Nordisk's. And they're just losing their market share day after day, week after week, and they're losing patent protection in major markets. So I'm like, dude, you guys are so dumb. So anyways, one of the players, the beneficiaries of Novo Nordisk messing it up was Hims and Hers Health. They created a generic GLP-1. They were crushing it, right? But not too long ago, I think in the middle of January, I think some court in the U.S. ruled that Hims and Hers Health, what you're doing right now, sir, is illegal. You have to stop. And dude, I'm going to be honest with you. Now I've changed my thesis on them. I'm absolutely bearish. So high risk. I'm not even going to say high reward. I just think it's high risk. I don't see the point of investing into them. Now, obviously, they're in the business of making profits off of people's insecurities, right? Receding hairlines, double chins, this or that. And that'll always print cash. But I don't think Hims and Hers Health is the route here. But also in that conversation with high risk, we also have the trade desk, which my bags are heavy. Dude, I'm down like $1,000 on that. I'm really sad, so I don't want to go any further with that. And then we also have Axon, right? I wanted to talk more about them. So I don't know how you feel about it, but this is their business model, okay? They sell body cams, taser products, handcuffs, everything that the law enforcement agencies, including ICE, and what's the other one besides ICE? I'm so stupid. It's Border Patrol, right? And one thing you have to understand is in the landscape of the immigration raids and everything that's happening, dude, their P&L, their financials have never been better. And they're basically catering to making sure that every newly hired ICE agent, Border Patrol guy has a weapon, has a body cam, has handcuffs, tasers. To be honest with you, I'll just reserve my tongue whether or not, it's a good business, okay? Now, having said that, let's go ahead and jump into each day of the week and take a look at any of the other lesser-known under-the-radar companies. And yes, I waited at least 30 minutes before doing my own little story times, because some of y'all get your balls tied up in a bunch and you get so mad whenever I talk about my personal life. But anyways, I've lived in Japan for the past 3.5 years. No, I'm not Japanese. And the reason why I'm here is because I followed my wife here. She got a job here. Doesn't pay much. Pays $21 an hour. But we talked about it and we were like, dude, when else would we ever live in Japan? When else would we ever have the opportunity to live there? And so, that's why we're here. And I just thought about it the other day when I was showering. Dude, I get some of my best thinking done when I shower naked. I don't know what it is. Like when the hot water hits me right in the chest and the water flows down over my fat pot belly, I just start thinking like a philosopher, right? Dude, I'm just so disappointed in myself that I'm not into any of their cultural offerings. I know there's a lot of Japanese freaks out there that love the country. When I say freaks, I mean people that have no ties, family members, or relationships to Japan, but they love everything about Japan. You know what I'm talking about. We all know at least one guy, such as like anime, manga, cars, baseball, Nintendo, or even their festivals. I'm not into any of that. And I'm like, dude, what's wrong with me? I tried, right? For the first year, I tried so freaking hard to get into their stuff. Just can't do it. It's like forcing someone to have a good time at a zoo if you hate animals. It's like, dude, I hate it here, right? But don't get me wrong. I don't think Japan's the worst place in the world. I've lived in Mississippi. You want to talk about the worst place in the world? Come talk to me about Mississippi. Dude, I don't know how the heck you decide to plant your roots in Mississippi and say, honey, let's buy our home here and stay here forever. It's hot as balls. It's humid. There's nothing to do there. There's mosquitoes that bite you all the time. And when it rains, dude, it's like it floods. It goes all the way up to your knees. Mississippi's probably the worst place in the U.S. I don't know if that's true or not, but for my own lived experience, right? But with Japan, I really do like the cost of living. For instance, like the price of eggs is like $1, right? 30 years ago, the price of eggs was also $1. Like in this country, like there is inflation, but it's so minuscule that it almost doesn't exist. Everything that, like in the 1980s, 1990s, the price difference to 2026 is negligible. And coming here while America was burdened with super high inflation, I always think about that and I feel so blessed. Because here, our grocery bills went down by at least 50%. Our gas bills went down by 50%. All of our bills went down because in this country, the cost of living, I would argue, is literally America in the 1990s. Yes, that's why I'm like, okay, that's one thing I really like. Another thing I really like about Japan is how safe it is. Honestly, it's like a cultural society thing. Obviously, there's some crazy folks that do mass murders and all that. That's every society, every country, but Japan as a whole, super safe. But having said that, essentially being bored in Japan, I think it was also a really good opportunity because it allowed me to pick up hobbies that I didn't have otherwise. Like soccer. Dude, I went balls deep into soccer at the end of 2022. I also really got into board games. Unfortunately, I tried so freaking hard to make friends with the Japanese people, but they're really a closed off type of culture. Like, unless you work with them in the same corporation, or they don't really go to church here, or unless you know each other but because you grew up together, they don't really like making new friends, from my experience. Obviously, there is a minority here where they like going to like language exchange groups and everything and trying to becoming friends with foreigners. But for the most part, they don't really like foreigners. And that's something people don't like to talk about. Yes, Japan, they don't really like foreigners unless your business is predicated upon tourists, like a restaurant located in Kyoto or Osaka, or you're a high touch point for a tourist destination. Then you love tourists because it helps make you rich. But for the most part, they do not like foreigners here. And I also really got into reading books, which is something that I wanted to do for the longest time, but I just could not do it. But being bored here, dude, I've been smashing and pounding books every day, which is pretty nice. Because in the past, dude, I'm pretty open about my mental health on this channel. I would just sit with my depression and be a miserable person. I didn't have any hobbies. I mean, I invested into the stocks, and I wasn't working out. I was just a terrible person mentally, right? I was just so upset with myself, my life, how things panned out. But I feel really happy that in Japan I was able to overcome that dark season. And I think a lot of that compounded with good habits, having hobbies, and just getting really into my passion projects, which is what you see right now, YouTube, right? So having said that, what's something that I should take advantage of while I live in Japan? Because I know some of you watching this or listening to this, you could probably give me a good recommendation, right? What's a household product that's a game changer? I know a lot of people rave and crave and sing the highest praises for Japanese products. To be honest with you, I don't see it. I don't really see a difference because their stuff is also imported from China. It's made by the same manufacturers and suppliers. Because I also had that prejudice. I was like, oh, wow, I think Japanese products are going to be amazing. Turns out it's the exact same thing that you get on American Amazon. So, but having said that, I think Japanese-made blades, like knives, kitchen knives, really solid. What else is really good? I tried to do Japanese shoes, like Asics, was not a fan. And so I just default to Brooks, which is, fun fact, owned by Berkshire Hathaway, Saucony's, and New Balance. I don't know what it is, but Americans just make shoes better. What's something else that Japanese cars are really solid. Like what we get in the US, dude, trash. Like, yes, your Toyota, Honda in the US is not as good quality as the ones that are made here in Japan. I will say that. But yeah, I'll have to think about that. And another recommendation on my end, if you ever come to Japan or visit Japan, dude, you gotta grab a bag full of the high quality green tea. Because in the US, dude, it'll cost you an arm and a leg, right? To get high quality matcha that's organic. Here in Japan, I'm not exaggerating, it's like $2 for 50 bags. I'm not exaggerating. So that would be my call out. All right, guys, now you see why I described this series as like a podcast, right? It's all over the place. But at the same time, if you don't take away at least one value add, one lesson, or something new about the stock market in general, then I failed. But I guarantee you, every episode you'll learn at least 1, 2, or 3 things that will help you. But anyways, instead of looking at it individually each day, I'm trying to do it on a weekly basis like this because I realize the time is already at like 40 minutes. Monday, let's see, we got Dominion Energy. To be honest with you, they have a huge tailwind. Dominion Energy, they operate utility and provide electricity to the state of Virginia, North Carolina, and some other mid-Atlantic states. And about 2 weeks ago, I was doing a deep dive and looking into the utilities to see if I can find one on discount or not. And I found out that Amazon, Meta, and all the other Mag 7 hyperscalers, dude, they're opening up so many data centers in Prince William County, in Loudoun County, which, by the way, I'm from Northern Virginia, and that's why it's weird to see the data center boom happening right in the backyard where I grew up. I mean, I grew up in the suburbs of D.C., closer to Arlington, that area, which literally borders D.C., But, yeah, Dominion Energy, huge tailwind on that end. And then we also have Kratos Defense. They're in the business of drones. Super bullish about them. Would I buy into them at their current valuation? Absolutely not. We talked about Domino's. Let me see if there's anything else on Monday. Yeah, Hims and Hers Health, that's a no-go for me. If you're invested into them, dude, I wish you luck, right? But that's an endeavor I will not be joining. Because I feel like there's so many good opportunities in the market. Like, why take a risky gamble? I don't know. Dude, I don't know what it is. My throat is acting up. Pollen season started here in Japan. And I'm hugely allergic to pollen. And it's kicking my butt. And I'm also waking up. That's the good thing. We also have American Tower, Cell Tower REITs, Realty Income Corporation. It might be an opportunity for me to buy more shares. I stand on this hill. They are pound for pound the best commercial real estate company out there. Super high quality. It's a buy and hold forever. Monthly dividend payer. Never cuts their dividend. We also have Ferguson. They're basically the Amazon, or I guess the Home Depot, B2B, directly to HVAC companies, directly to plumbers. A startup that's similar to Ferguson, I don't know if they're publicly traded or not, is Supply House. They're doing the exact same thing that Ferguson is doing. They should have a tailwind from the HVAC space of how data centers need a lot of cooling. There's Keurig Dr. Pepper, Workday. Now, Workday is a company that I should have covered in the tier system video. After getting to know them, I think they are in the tier 2, because I think it's an enterprise backbone that connects so many different departments with their services, right? But at the same time, I think they're one of the more low-quality backbone enterprise software. Like, I would rather go with Salesforce, ServiceNow, or SAP, or even Oracle before I consider Workday. If you don't believe me, pull them up and look at their financials. It's not as good as the other ones. We have First Solar panels. Let's see. We got CoStar Group. This is a company that I talked about in the tier system video, tier 2. I'm pretty sure this is a REIT that's in the business of, here, let's pull them up. I think they're in the business of like the weird niche real estate markets like RVs and trailer parks and, hold on, I could be wrong. Let me pull this up. Okay, they don't go over that. Here, let me see if I can pull it up right here and I'll tell you guys. It's a really niche space, but I also think it's not the worst. Real estate landscape. I'm literally just Googling it right now. Yeah, so it's a REIT in the business of renting out manufactured homes, so trailer parks, RV parks, and marinas, although they're selling it off right now. So I don't know if this is a bad thing, but I saw a video this morning. I think it was from the Wall Street Journal. It was talking about how like RV living and people living in their cars is on the rise, at least here in the US. And I don't know, right? I think that's a tailwind for some communities, but the humanity and the heart aspect of it, dude, that's sad to know a lot more Americans are not being able to afford life and they're having to live out of their cars or live in RVs. So if you live in an RV, you got to park it at an RV park, right? That way it can be hooked up to water, get rid of your black water, but also to get power. You can't just park your RV in the middle of nowhere. I mean, you can, but yeah, it's kind of sad. So with Sun communities, I definitely think they have an environment where they should be thriving, but it's also really sad what's happening in the US. That's why I also think financial education is so important. Like if you're watching this video, it's a testimony that you understand how to save, how to invest, how to not carry credit card debt. But for the most Americans, that's not the reality. I think it's something like 50, 60% of Americans, if they're hit with a $2,000 surprise charge, they would be belly up. They would be screwed. Most Americans live paycheck to paycheck, right? It's, I don't know. I feel like that's one thing our curriculum and education system could do a better job of is how to prepare the young kids at age 15, 16, 17, 18 for the real world, right? Like stop doubling down on certain subjects, but instead allocate 45 minutes per week of teaching them how to invest, how to take care of your money, how to increase your credit score, how to properly network, how to this or that, the ROI for trade school versus college versus breaking it down to the major. Like here's the thing, I think the humanities and the arts, it's nice. Like if you come from a rich background, it probably doesn't matter. Your daddy will hook you up with a job anyways. But for the most part, dude, you gotta pursue a degree that's in demand, a degree that's gonna pay off, like engineering, robotics, biochemistry, stuff like that, right? I feel like the kids these days, they don't know, right? At age 18, it's like, all right, here you go. Welcome to the real world. And a lot of them just start racking up credit card debt, student loans, and they don't invest. I don't know. It's sad to see. But anyways, that's one of the purposes of this channel. Because every now and then I'll get someone who's sick and tired of living their life the way they've been, and then they come across dividend investing, and then they run into the channel, and then their life changes, the trajectory of it, right? Once they start understanding, even just investing $20 a week or like $80 a month, dude, that can rack up to like $300,000 by the time they're like 55 years old, especially if they discover the channel at like age 22, 23. And that's not a get rich overnight quick scheme, right? Like day trading and whatnot. Or like crypto or sports gambling. They promise that you can become a millionaire within a year. Dude, dividend growth investing, that's not going to happen. Fat chance. But it puts you onto a path of becoming a disciplined investor, right? And I think that's what's more important. And through that, you learn to become patient. You learn to ignore short-term noise. You learn to be diligent. You learn to be consistent. I think that's important. I think there's people where you'll work out, you'll have like a fat loss goal. You'll go hard in the paint for a week and then you give up, right? Same with dividend growth investing. There's people that don't see an ROI happen within a week. They give up and they go straight to day trading or gambling. It's like, dude, this is something that only works if you're consistent and you stay on the path of being a disciplined investor. Dude, I might even change the freaking name of this channel. Instead of Dividend Compounders with Cheese, maybe it should be Disciplined in Dividends. Something like that, right? Because it only works if you put in the work, right? And that means like being consistent, not being emotional and panic selling, not doing FOMO and investing into something after it's already gone up by 50%. That's the quickest way to lose your money. But anyways, anything else on Tuesday, guys? Mosaic, Kava Group. Like, this is a company that's kind of sad to see what's happening to them. Dude, they're getting smashed beyond belief. It's the Mediterranean version of Chipotle. But I think it makes sense. I think the market right now, they don't want to go near companies that are just not fruitful, with Kava, they're in the high growth, burning through cash phase of their life. And I think the markets are like, dude, we don't want to be a part of that right now. Come talk to us once you're more profitable, like McDonald's, once you're more established. Yeah, it's just I think the market cycle right now, they're going in a phase where it's like they're de-risking. Anything that's too much risk, they're just jumping ship. And I don't blame them. Yeah, we got Zeta, kind of like a parallel play to the trade desk, but more so with digital marketing. Yeah, I'm very bearish on anything to do with the alcoholic space because I did some market research like 3 months ago, I think in November, because I was personally looking into the alcoholic stocks as well because they were down by like 70%. And I was like, what the heck is going on here? I was like, why are the numbers declining? I think number one, it's the ramifications of the tariff situation. Less people are trying to import American-made alcoholic beverages because of the tariffs. But then number two, it's a consumer trend, a shift that's happening. People that are under the age of 30, they're drinking less and less, and they're going more and more towards other substances like tobacco, which is kind of weird, right? So with alcohol, I feel like their future trajectory, I just don't feel confident in, and it's just a sector that I don't feel good about investing into in the first place, right? So for me, my takeaway was I don't care how low, the Boston Beer Company or some of the other beer stocks get. I just don't want to go near them. Here's a really high quality S tier insurance stock slide. This is a company that I invested into and sold out of for a quick little profit last year. They're predominantly servicing South Carolina and Florida, so not the biggest player, and I think they just IPO'd. And if my memory serves me right, from the industry breakdown video, they are in the S tier. Now, obviously, they don't pay a dividend, but nonetheless, still in the S tier. But I think, I don't know, let me write that down on my notes. I think it's a company that I want to circle back on and see if the fundamentals and financials are still S tier. Yeah, let's see. I think this is the company, Camping World, that sells the RVs themselves. I did some research on them. Acting like I'm a scientist. No, I started looking up some YouTube videos, TikTok videos, Reddit posts of people buying their RVs from Camping World. Dude, everyone hates them. They hate them so much. Reason being is like their sales tactics, their support after you buy their products. But yeah. The reason why I looked into it is, I don't know, I was thinking about RV living as well last year. Obviously not going to happen here in Japan, but once we move back to the US, like, is it feasible with a growing family? Honestly, I think an RV is nice, but I found out that there's a lot of mold issues because the humidity just builds up inside of the RV, and then you also get like cabin fever because everyone is just like smashed right next to one another. There's not a lot of space. Because here's the thing, I'm trying to buy a home. I've never owned a home. But the prices of real estate right now is super unfair. And so I was like, well, what about an RV? An RV will set you back like 80 to 100 grand. It's like 3 bed, 3 bath, and you can move it anywhere. My takeaway is I'm going to be patient and wait for the market to have a correction and go back into a buyer's market. Because every like 10 to 20 years, that happens, right? And I'm being patient because I live in Japan. I can't even buy a home in the US right now anyways. But one thing that I do qualify for is a VA home loan. So there's that, right? I don't have to do the down payment and everything else. So, yeah. Anything else on Tuesday? Anyways, yeah, let's just jump on. Oh, there's Portillo's. I think they sell like the sausages and hot dogs. And I tried it in California. Dude, I don't get what the hype is. Not that good. And I think they're a penny stock. If I were to look them up right now, Portillo's. This is probably one of the lowest quality restaurant stocks. How's their financials? Actually, I don't want to do a deep dive. Actually, another one that's really low quality in the restaurant space is Noodles & Company. So much potential, poor execution. What's another one? I think another one is brands, dude, 25 cents a share. They're going to become delisted any second. So when I talk about like best in class, these are not it. Like Wendy's also belongs in this conversation. Best in class in the restaurant space right now, I would say Darden, parent company of Olive Garden, Brinker International, parent company of, I think it's Maggiano's and Chili's. Maggiano's is so freaking good. Let me see if I'm right or wrong. Yeah, Maggiano's, but also Texas Roadhouse. Like, I don't know what it is. Like, why do people bother investing into the cigar butts, like the ugliest and the hairiest in a sector? Like, why go near Portillo's? Why go near fat brands? Why? I just don't understand the psychology. Like, when there's a Texas Roadhouse, when there's a Brinker International, why not? I think in the middle, though, is Cheesecake. What's another company that's like in the C tier? I think one of the franchises for the Burger King and Popeyes, I think they're also in the C tier. What else is in the C tier? Yum Brands is C tier for me. But anyways, yeah, obviously Wednesday is a really big day. Me personally, I'm going to be paying attention because if I can buy into NVIDIA, I'll do it. I'll do it. But I'm not going to buy into them at 180 a share. Okay, let's see. Vici Properties, real estate, just in Las Vegas. I'm bearish. Zoom, you know the company that makes the video conferencing software? Tier 4, super bearish, would not go near. Let me see if there's anything else. This company right here, Essential Utilities, they're being acquired by American Water Works, so they're going to be delisted very soon. Owens Corning, is this the one that makes the glass products, or are they the one that sells like the house building insulation products? I always get the two Cornings confused, which is really funny because in my MBA program, I had two friends that each worked at the respective Corning. And that's why it makes it even more confusing. Actually, can I just pull them up real quick? I cannot remember. Yeah, so this Owens Corning is the one that sells the house making products. Anything else? Oh, here, can we talk about BXSL right here? Blackstone Secured Lending. This is a BDC, and it's one of the more high quality ones that pay a fat dividend in the ballpark of 10%, alongside with Ares Capital, Main Street Capital. I'm going to tell you guys right now, BDCs last year I sold out of for a fat profit because I saw what was happening, right? The interest rate cuts were finally happening. All I'm trying to say is I love them, but I'm personally waiting for their prices to drop further. Why? Because as the interest rates get cut, historically, the BDCs get hammered. Why? Because their dividends are also going to get, I guess it's like a consequence, it's also going to get cut. I don't think Main Street Capital is going to cut their dividend, but I think BXSL, Blue Owl Capital, Ares, I think their dividends will get smaller. But anyways, when the interest rates get smaller, so do the valuations of the BDCs. So I personally plan on buying into them once the interest rate cuts hammer their prices lower and lower. So I would argue BXSL is probably in the A tier in the BDC landscape. Probably one of the better ones. Anything else? There's EPR Properties. That's a monthly dividend paying rate. This is off of memory, by the way. And all of their portfolio is based on experiential stuff like museums, Topgolf, laser tagging, stuff like that. And I'm personally very bullish on that. I think we're turning into a pivotal moment in society and history where for the longest time, everything has been going virtual and digital, right? Even online dating. But I think in 2026 and onwards, I think as humans, we're craving how we were designed, which is relationships, community, and going in person to do things. So between you and me, I mean, I could be wrong, but I definitely think EPR has a tailwind in that regard if that pans out. But if everything still continues to go online and digital, obviously I'm wrong. But personally, I think anything that's in person is going to see a tailwind soon because I think we've gone too far in the other direction of closing down shopping malls, of closing down third places. Because as a society and as a community, we used to have a third place that we went to outside of our house and outside of work where we used to mingle and hang out with people, right? It used to be in a church. It used to be in a bar pub. It used to be in a what, right? But it's all going away. And I think as humans, it's driving us nuts and we're trying to bring it back. Or at least that's what I think is going to happen. Like if I think about the business landscape, like if you open up an in-person whatever, I feel like you could kill it. You could crush it. Especially if it's an industry that's predominantly online. Because I'm telling you, there's a market of people that are craving face-to-face interactions, right? Like when you walk in the door, everyone needs to put their phone in a cubby or in a locker and you cannot access your phone and you have to just interact with each other. I think people would pay to do that. If it's a society, if it's a club where everyone abides by the rules. I don't know. Just something to think about. Anything else on Wednesday? I mean, obviously there's 228 companies. Manchester United, dude, I would never invest into them. Poorly ran club, and the profit margins for a football operation is razor thin. So, I mean, it's cool, but I would never invest into them. Let me see if there's anything else on Thursday. I mean, there's a lot of the heavy hitters in the bank landscape, but obviously Canadian. And I think we also had BMO, which is another Canadian bank right there, Bank of Montreal. Oh, and there's Intuit. Between you and me, Intuit's tier 4, right? Because it's a horizontal tool. Like that, objectively, they're tier 4, but I didn't really talk about it in the landscape video. I think it's one of the best ones in the tier 4 category. So me personally, I'm not telling anyone else what to do, okay? Me personally, Intuit's on my radar. I'm genuinely hoping they sell off so I can buy into them. Because I do think some people will jump ship and stop paying QuickBooks TurboTax and instead go to a Vibe-coded software to do their stuff. But once they realize the amount of mistakes, once they realize the regulatory hurdles, once they realize that all of their tax information is already with Intuit, I think Intuit's going to survive. I could be wrong, but I do like them. I don't like them at their current price, but I do like them enough where I would want to be a business owner of Intuit. And we also had Vistra. I really like Vistra. I think any utility power generation company that has a foundational basis on nuclear, I really like. Because I think we're learning that we went too far in the propaganda of villainizing nuclear energy. It's one of the more clean ways to do it as long as you have safety plans in place, right? Obviously, if a nuclear reactor or nuclear plant goes haywire, there's ramifications that affects the entire area. Like I think in Russia, what was it, like Chernobyl? But nuclear, I'm super bullish on. I think pound for pound as a society, that's what we're going to go towards instead of solar, instead of wind, instead of hydro. Nuclear is probably the cleanest way and pound for pound output, the best way to produce power. Because coal, I mean, it's good, but it's a finite resource. With nuclear, and that's why when you think about some of our equipment, like submarines, why do you think it's nuclear powered, right? So I just don't like how they're trading multiple. I took a look at them, I think yesterday, they're trading multiples like a 65. I don't want to buy into a utility business with a PE ratio of a 65, okay? But yeah, there's Autodesk. I really like this one. Also tier 4, but I think they're better positioned to survive the SaaS sell-off. Let me see if there's anything else right here. There's Coupang, which is the Amazon of South Korea. They're going through a hot pickle right now. There was a data leak that happened, and then the South Korean government sued them, and they went to court, and then a whole bunch of other issues was exposed. And I was following it pretty closely because I'm a Korean, and the way that they were treating their workers, the compensation, and everything else got exposed, and that company, through PR reasons, their stock price got hammered. But business operations-wise, it's still sound. So there's that. There's, I think Thursday is probably, well, Wednesday and Thursday, probably the more exciting days of the week. There's AES Corporation. They're basically, they generate power and then sell that power. And their main customers right now is Meta, Microsoft, and Google. This is a company that I bought into, I think like a year and a half, 2 years ago. $9 a share, sold out of them at $13. And I think right now they're $16. Kind of wish I held on, but I can't be upset at like a 40% profit. MP Materials. This one I'm bullish on, but I really don't like their financials right now. This is a company that's in the business of mining rare earth metals. And the US, dude, the government is pumping money into them because rare earth metals are so freaking important for the next generation of technology, right? This is a company that I like, but not enough to buy. I don't know if that makes sense or not. And let's see if there's anything else. Duolingo, Main Street Capital. Man, there's a lot of heavy hitters on Thursday where I'm kind of like, There's a timeshares company. I'm not really bullish on timeshares. Although right now, as I said earlier in the video, the top 10% of society in terms of income, they're propping up the economy. They're spending more than ever. Whereas the bottom 90%, we're trying to save our money more than ever. So when you think about timeshares, they're not trying to sell a freaking timeshare to a struggling working class family. They're selling that timeshare to the millionaires. They're selling that timeshare to your supervisor, the senior director, the vice president of your corporation. So timeshares right now, I do see a tailwind for them. And that's why when I think about the payment card landscape, I said it time and time again in this channel. My number one is American Express. Their business model is more resilient because the top 1% will continue business as usual. Unless, of course, they go belly up. But after American Express, I would argue it's Visa. And then it's a toss-up between MasterCard and Capital One, parent company of Discover as well. Yeah. Visa, on the other hand, dude, they've been struggling. Really. They're not doing too well. There's Shake Shack. It's a burger joint, premium prices. It's like $14 to get a burger, fries, and a drink. Almost the exact same price as Five Guys, but you get less food. The reason why they're crushing so hard is because in China right now, I mean, think about the Chinese population, right? It's like 4 or 5x that of the US. Dude, they love Shake Shack so much. It's ridiculous. Like Americans, it's okay. Like we like it as well, but the Chinese, they can't get enough of Shake Shack. So that's the growth catalyst for them. But I don't want to buy into them because should we talk about Shake Shack? You guys want to talk about it? Take a look at their trading multiple. It's a 91. Now, obviously, their numbers look really good, but I cannot justify a 91 PE ratio. Just between you and me, okay? I do like Shake Shack, but not enough to buy into them at a 91. Hold on, someone rang the doorbell. I'll be right back. Sorry about that. My wife sold some of our cloth diaper stuff to some Japanese neighbor, which, by the way, it's as gross as it sounds. When you do cloth diaper for a newborn or a baby, you basically wash off the doo-doo and use it again. But it's one way that we're saving money, funny enough. And another company that I want to talk about for Thursday is SoundHound. Dude, I really do not want this company to succeed. They drive me up a wall. They're in the business of using AI to talk back to people. So the perfect real world case, one of their main customers right now is Wendy's, funny enough. So when you go through a drive-through window, like, don't you want to interact with someone that could customize or take your order, right? With this, SoundHound and Wendy's, they're replacing humans and instead using AI to take your order. Have you ever dealt with AI customer service when you have an issue? Just imagine how much more annoying it is when you're trying to just get a freaking a Dave's single burger and he keeps messing it up because you're talking to AI. Dude, I do not want SoundHound to succeed because I don't want AI to take over the drive-through window. Okay, like, I don't know. Is that a weird take? I just want a human. That's the thing. Whenever I find out a company has human representatives for customer service, they get my business. I'm serious. When people outsource their customer service to AI, that tells me everything that I need to know. I do not want to give them my money. Like, I vote with my wallet. One of the primary reasons why I jumped ship with my previous startup brokerages and went to one of the more old school ones like Charles Schwab, because they actually use US-based customer representatives that understand the issue that I have, right? And I don't really have that many issues, but it's just important to me. Yeah. There's Wolverine Worldwide. This is a company where when I took accounting for the first time, this is the first business that we did a case study on to learn the principles of the balance sheet and everything else. And they're the parent company of like 15 different shoe brands. I think the only one I can think of off the top of my head is Sperry's. Dude, I am so not bullish about them. Wolverine Worldwide is just, dude, I don't get it. Why invest into them, right? And then Friday, there's 99. Is there anything that makes you scream, that makes you excited? I'm doing a speed run right now. Let me see. Well, I think I'll just call it right here. Anyways, don't leave. I want to talk about something, okay? So the other day, I came across this quote, and it's burn the boats, right? So simple, burn the boats. And it's in the context of pursuing your dream or project with full throttle. You have to imagine that you're sailing to an island. Now, when you get there and the boats are still on the shore, if things go wrong, if things are hard, if things are rough, you can retreat, you can escape, right? But if you burn the boats, you have to make it work. No plan Bs, no backup contingency plans. And the thought process, and I guess the rationale is this. If you have the boats still docked at the shore, at the first sign of struggle, at the first sign of a speed bump, at the first sign of feeling stress, you're going to dwell on quitting and defaulting to what is easy, which is giving up, going back to what is comfortable, going back to what is safe. And obviously that's a lot of color and commentary that I'm adding from just the phrase burn the boats. Funny enough, dude, that's exactly what I'm doing right now. For those of you that don't know, I mean, I know I referred to it earlier as a passion project, but I turned my passion project into my full-time job. I do YouTube full-time. Every day of the week, I upload across multiple channels. And yeah, I essentially burned the boats a while ago. Now, thinking about what's happening in my life, dude, it's amazing because it allows me to stay at home and take care of the baby while my wife goes to a normal job. Right? So I burned the boats even before all of that. I quit my corporate job 4 years ago and I went all in. Like when we moved here to Japan, I was like, dude, what the heck am I going to do? And then I was like, you know what? I'm going to go all in. I'm just going to stop treating YouTube as a hobby, and I'm going to see if I can make it a full-time living. Now, obviously, it's been a struggle. Obviously, it's been really hard. Obviously, it's taken so much sweat, tears, and time to get up to where I am right now. But, dude, if you want to build something that lasts for the long term, you got to sacrifice short-term comfort. And that's something that I learned really early on about delayed gratification. I think so many of us are so impatient. So many of us want to see 20, 40xing our money overnight. And if not, you start cussing out the stock market. You start, gravitating towards shortcuts. And that just ain't it. Good things take time. Good things take persistence. Good things take perseverance. Even raising a family, even a relationship, even progressing in your company, even just becoming a better human, we all stumble along the way. We have our bad days, we have our moments, but over the grand scheme of time, what's the direction that you're heading towards? Are you making the right transactions and the modifications to being a better person or not, right? And one way that I'm struggling right now, it's intermittent fasting. And what that means is you go, like, there's various ways to do it, right? An 8-hour window of eating, 16 hours off. You could do it 12 hours on, 12 hours off. And I've been doing that. And dude, it saves money, right? It sucks. It's one expense that I cut out that has compounded quarter over quarter. I skip lunch. It sucks. But when you think about it, it's one of the sacrifices that I'm making to make this freaking YouTube thing work. Like, I'm not trying to boast. I'm not trying to brag. I know I'm smart enough to pivot back into a strategy role in corporate America, but that's not what I want to do. I don't want to do that. I don't. I'd rather do YouTube. I'd rather be able to stay at home, take care of my baby. I mean, between you and me, my wife would prefer if I would just eat like a regular person. It drives her nuts that I skip meals to save money, but you got to do what you got to do. Now, obviously, once YouTube starts popping off, once we start getting a community built up, and we start, having money flowing in, dude, I'm not going to do intermittent fasting. Absolutely not. I love food so much. So it's one of my rewards and one of my goals that I'm running towards. It's like, dude, the faster this pays off, the faster this pans out, the faster you can go back to normal. And I've been doing it since 2022. But on the other end of the argument, I think what makes all of this funny is that even though I'm trying to save money by skipping a meal a day, we also, as a family, we donate our money every single month to a handful of organizations like animal shelters, orphanages. We also sponsor a child from Peru, and we've been doing so for at this point, 15 years or something. And obviously we can cut all of that out, but I think as a family, it's just an expense that we don't want to cut, right? And we think, even though we're not well off, we're still blessed, right? We're blessed that we can actually afford to pay and have a roof over our heads, to buy groceries and everything. So if we're in that kind of position, we feel like it's the right thing to do to help other people that are not as well off, if that makes sense. So, I don't know, just something about me. All that to say, good things take time, consistency, and patience. Just like dividend growth investing, obviously you can apply what I just said to whatever it is that you might be dealing with in your life. If the shoe fits, wear it, right? So many of us give up and quit right when we're about to cross the finish line. Like, you don't know if that breakthrough is about to happen next quarter, next week. You just got to endure and just go a little bit longer. Obviously, be sensible. Obviously, have a game plan of when you're going to throw in the towel. Like, for me, it's 2028. If this doesn't happen by 2028, dude, I'm quitting. I'm giving up. But I feel like I think we'll get there. Having said that, hey, I love you guys. Stay safe. Good luck in the stock market. I gotta get going on with the rest of my day. So, yeah, love you guys. See ya. Peace.